right, good morning, everybody. So we're mostly green on the screen, a little bit of red out of Japan, Hong Kong near flat. The Dow is flat. We got the Russell less than a quarter, the S&P at a quarter, and the Nasdaq near a half of a percent. Today is CPI day. So we have the opportunity for a liquidity gap like we had last week. Um, we didn't get one last week, at least not a good one. The gap eventually did get closed, but there was not the clean print that we have to have at the beginning to trigger that specific strategy. There's really not a whole lot on the table today other than that. Once we get on the other side of CPI, we have OPEX on Friday. And so that's going to be the next thing we want to focus on. Yesterday was a hurry up and wait day. The anticipation for that is that we would chop and it would be violent. In fact, someone yesterday mentioned you should just say that it's going to be choppy. And it was funny because in my mind, I thought I already had. A hurry up and wait day is a choppy day. They're synonymous. So whenever you hear me say that phrase, or you even just think that today's going to be one of those days, choppiness should be the first thing you think of. So there were trade opportunities yesterday. There always are. But with the tools acting the way they do in a choppy environment, the conviction of the setups are always lower, right? So there was some plays. Just trade them a little slower, a little lower, less conviction, less size. We have additional auctions today, including the 10-year. You know, you're not supposed to have favorites, but if I did, it would be that one. Once we get through CPI, we're not out of the woods with this hurry up and wait. That isn't going to perfectly translate though, because we're going to get volatility today. So the market's going to want to move. It's going to want to price in the potential for a different dot plot scenario. This data isn't going to change the Fed's post about rates, right? They're not going to cut because of this data, and they're not going to raise, but they won't make a decision about cutting or not based on the data we get. But the data we get today will absolutely impact how they present the dot plot, what they think about when they're going to cut, and what kind of conditions they want to see before they're willing to cut. So this data is important, even though it's not going to, force their hand to cut or not cut. So the market's going to very likely respond to this data today. Now they're going to hedge. And as we've talked about before, when they hedge like crazy, we don't really get too big of a sell-off because nobody's offside and nobody was caught by surprise, right? They don't have to sell or buy to change their position. They're covered. If it goes up, they're safe. If it goes down, they're safe. Surprises is what usually really jacks the market in one direction or another. So when they're prepared and they're hedged, big moves kind of get taken off the table. But there's still the response after we get the data of what the market thinks it's going to do to the Fed and their dot plot. They can't hedge that, right? They're going to have to reposition a lot of other things if they think the Fed is going to readjust the dot plot based on this data today. Instead of a rate cut in June, maybe they'll be pushing it out to July or even farther out than that. They may try to bring it in a little bit. So because of that, we could still see big moves today beyond the hedge. Hopefully that makes sense. And bad news is good coming out of Europe. That's why they got a little bit of help over there. They had bad news, and they took that as a good sign to lower rates, right? It's all about the rates, even over there. So bad news is good still, at least in Europe. And there's still talk about the Bank of Japan looking at a rate hike coming out of that zero regime and really changing the face of the world. It's a big day today. Make no mistake about that. So we can see that they're hedging this morning, and they are hedging um, pretty well, right? I got to say that that's bigger than the hedge we saw last week, which was sitting around $20, $22. This is $63. It's 1.2% above the highest ADR level, right? So 52.43, and then we would add another $63 on top of that. You're looking at 53 something on the upside, and to the downside, you're looking at about 50.70, I believe. Just some off the cuff napkin math, but that's pretty close. Of course, if you're sitting there anxious with your calculator, then you can always just nerd out on the numbers. We have an MDP from yesterday, so it counts yesterday on today, but we were underneath it, and now we're already above today with a new MDP. MDP is missed daily pivot. We didn't hit it, therefore we missed it. It's registered all through the day yesterday, but it doesn't count until the end of the day that we made it all day without hitting that pivot point. Now that would have impact on us today if we didn't open today above the pivot point. So now that we did, and we're working on a new missed daily pivot, then we need to not hit this lower pivot. It lines up really close with the 10-day moving average, which we happened to have got back above yesterday. And while we're not perfectly centered inside the two ADR lines, we are in the middle, closer to the upper end. And if it wasn't econ this morning, then we would expect to gravitate to the upper end because we're closer to that side. But because of CPI in a hurry up and wait scenario, we're going to expect to kind of grind and chop till we get the data. There's no amount of technical analysis out there that could ever prepare you for which direction we're going to go. Sometimes bad news is good. Sometimes good news is good. I heard a couple of different hypotheticals on what the data is going to be today. Both sides on the low end and the high end both seemed very confident in their numbers. And then we had Jamie Dimon come out saying, since COVID, a lot of these tools that the Fed uses are shot, that they're not working correctly, that they got some sort of imbalance in them, and that he doesn't trust them. So, you know, everybody in their camp seems really confident with the numbers. And then Jamie Dimon seems really confident in the fact that the numbers are trash. So we don't need to guess or assume which direction it's going to go. We can just prepare for either direction, and whatever we get, we got a game plan to trade it. We do have a gap close play. I mentioned that at the start. This is a particular strategy that I really like. We get a chance 3 times a month to do this strategy. I had a few people on Friday say, hey, that was great. It worked out just like you said. But to me, it didn't. Now I'm a little more picky. It's my strategy. I know exactly what I'm looking for. Um, if we don't get the setup, it doesn't mean we can't trade. And there was some good trades last week when we were expecting that gap close. But this is what I'm looking for. And if it doesn't look exactly like this, then I just throw the strategy away for the day and I do something else. So at 8:30, we're going to get a data print up or down. I don't care which direction, but if it goes down, I don't want any wick across the top. None. I want it to immediately fall if that's the direction it's going to go with no upside movement whatsoever. This tiny little wick that we can see in there, if I zoomed in really close, is about as much wick as I want to see. Same thing if we flip it over, if we get positive data today and it goes to the upside, I want absolutely no wick on the bottom of that thing. Now, once it starts moving in a particular direction, I don't care if it's one candle or 5 candles or whatever, it can keep moving in that direction until it pauses, begins to base, and then we'll look for the flip and run it back the other direction. So it doesn't have to end with one single candle, but it doesn't, I don't want it going back in the other direction. Got the gap closed around 11 o'clock in this example. So here's another one, 8:30 print. You can see it didn't go down at all. Tiny little wick down there. Otherwise, we got candle on the 5-minute. We got back to close the gap around 11 o'clock. Here's one of those multi-candle examples. Still almost no movement to the downside in this. It was going up. It didn't go down at all. It didn't even try to go down. We had multiple candles. And even in the pullback here, it's not captured in this, but this wick across the top, I find that acceptable. But if it had gone more than 50%, I would not have found that acceptable. So if we do get that single print push, but then the market falls back and the first candle closes even close to that 50% mark, I'll throw it out. I won't trade it as a gap close play. This is tolerable. It's acceptable. So I need to find one where, you know, it has a good push, but it failed to keep the drive to the upside and closed near the middle. And if you do find those kind of examples out there, what you'll see is farther along in this part of the play that things begin to fall apart, right? So there's a method to my madness. There's a reason I'm particular about the way it's supposed to show up. So here for an example, this has been shown as one that worked, meaning it came back and it closed the gap. But this isn't one that I would have traded for a number of reasons. One, it does have that little bit of wick on the bottom. Two, it pulled back substantially before it closed. It's not at the midpoint, and I have that midpoint marked to show that it didn't close below the mid, but it sure closed near the mid. And it got back and closed the gap even before the market opened. So from 8:30 to 9:30, 1 hour, and the gap was closed. I don't generally trade between 8:30 and 9:30 anyways, so I didn't trade this, but I wouldn't have traded it anyways because the whole thing just doesn't line up with the rules. I don't want it that close to the 50 at the end of the first candle. Here's some examples of obvious failure. We get something that looks like this. There is no gap close play. So big wicks on each side closing near where it opened, no gap play. Same thing as a different one here. Same thing as a different one here. So it's a little bit of paint by numbers. All you got to do is see the setup. If it looks the same as the others, like playing mahjong, you know, recognize what it looks like, and you've got your destination. You're not going to necessarily have each candle by candle movement all the way to that destination, but if it's going to do a gap close, you know where we're headed to get the gap closed. Simple enough. The really good thing about building a strategy is it's yours. Everything that is in it, you know and understand because you built it. You'll never trade somebody else's strategy as well as you'll trade your own. So it's something to think about if you're struggling with strategies right now. So we've got light volume, we've got hedging. Later in the day today, after we're past CPI, say around noon or so, you want to take a look and see if they're still hedged. If you look at Spot Gamma and the founder's note today, they laid out the case for the SPX at 51.50 for OPEX. That's where the options levels look like price might pen. Penning is kind of an older concept that because of the more and more traders that are getting into the market and the way that data is shared and more people understand options, we don't pen as much as we used to, but penning still does take place. And right now, 51.50 seems to be kind of the line that we might want to target. So if we get done with everything else this morning, might price what it looks like for a 51.50 butterfly for the Friday expiration on the SPX. If you're somewhere other than Thinkorswim and you don't have a market maker move label like we have here, then you can just go to your futures. Notice that this is yesterday's. It shouldn't even be there. It's just a quirk. So that one doesn't exist. But then we have the 0 day today, which is at 19.28. And we have tomorrow's, which is at 17.12. When the front end is higher than the back end, you've got a market maker move. So no matter what trading platform you're on, as long as they have options, go to the options implied volatility average right here in the options chain and look to see if the front one is higher than the back one. If it is, they're hedging. Afternoon today, as we get into the later part of the day, you want to see, are they still hedging? And it won't, at this point, it won't be here. You're going to want to look for Friday. Are they still hedging for OPEX? Ten-day, 30-minute volume profile, it's still significantly narrowed at this point. 100 points wide, 51.20-ish to 52.20. 52.50, excuse me. It's about 130. We're not going to lose the shape of this anytime soon. You can see through most of the week, this lower level is going to hold. So we've got days here of volume that needs to be taken out. No matter how much we go this way this week, we're not going to lose this. So the lower end of this profile is still going to be there. And even after all of those, we've got that one. The only thing at this point that would make us lose this low is if we drop down below 51.20 and start making new lows. This is the standard deviation zone right there from 52.11 to 51.43. So 70% of all the volume is within this very narrow range. And that also isn't going to change anytime soon. Even a lot of the data that we're going to lose down here, a lot of this volume, a lot of it's outside those bands. We're not going to lose the point of control. We're not going to lose the value area high and low. And we're not going to lose the peak or the trough. There's basically going to be no change to this at any point in the near future unless we break out of the upside or the downside. the gap close trade is a short duration trade. It's an intraday trade. So it's not supposed to be a swing trade or anything like that. Not the way I trade it. But like I already mentioned, you'll do better with your own strategy than you will trying to mimic somebody else's strategy. So you already know the groundwork, right? You already know the target, the destination. You know where it's supposed to go. If you want to hold it 4 hours, 4 days, 4 weeks, that's on you. You're more than welcome to. I expect it to get the gap closed, and the gap is supposed to close within a reasonable period of time. Most of my data shows by around 11 o'clock. Now, I'm not going to bail out of it just because it doesn't get the gap closed right at 11 o'clock, especially if it looks like it's still moving in that direction and it's going to get there around 11:15 or so. But even just finding some of these examples like we have here, you could see it was already moving in the right direction, right? I'm not going to negotiate with this thing about 15 or 20 minutes. I'll let it ride. But if it's midday and we're still tinkering around the, say, the low here, not even working on that gap, the whole thing is thrown in the trash. It's done. It didn't do what it was supposed to do. I'm done with it. If it continued to go down and didn't even attempt to go to the upside, I'm done with it. Throwing it away. I'm moving on to a different strategy. This isn't a trade of hope, right? It's supposed to do certain things, and if it doesn't, I'm out. I'm going to go do something else. So you got the destination. You know what the setup looks like. Got examples here. You can screenshot those while I'm showing them. You can Google CPI days and go back in the past and find these days for yourself that you can apply your own indicators to it and your own look back to it. However you want to do it, you've now got what a liquidity gap looks like. And these three that I show, CPI, non-farm payrolls, PPI, these are just an example of a gap close, but we get these all the time, all over the place. So you're going to want a gap close strategy, right? Because not just this, but the intraday ones that we get all the time that aren't so big, they're not so violent, they're not so strong, but they still have the same gap close criteria, the same setups, the same follow through, destination trading, right? We're really just going back to a set spot on the chart. So you make the decision about how long you want to hold it and whether you're going to continue to hold it over days and weeks. And I won't, no, because I mean, it's supposed to get its butt back down there and get the gap closed. And I'm not going to play hope. I'll play the setup, what I have. This structure is not going to change unless we break out of it. That's the long and short of this. It's basically a D shape, capital D. So unless we get through it somehow beyond it to the upside or to the downside, nothing inside this in the center is going to help us out at all. We got a new VPOC. So we can add that to any break to the downside. And we got to take one off from Friday because we ran over it last night. $51.92 is a cog line, and that wasn't right at 51.92, but that whole zone should be marked anyways. I think maybe we should have left it on there, not as a VPOC level, but as a level of interest. And we're going to keep that. Don't let it get too complicated, right? It's just a simple reversion to the mean strategy. Just like every other reversion to the mean strategy, there's got to be a set time where you decide, I'm done with this, right? So you're not trading hope and faith. We're basically right where we ended the day on Friday. The whole idea of hurry up and wait into CPI so far has borne fruit because we haven't done anything since we closed on Friday. We're exactly where we were then. The fear is that this hurry up and wait is going to last all the way to Friday at the close. That's going to make it a choppy, nasty week where a lot of our tools and signals don't really function all that well. And then we're stuck using smaller position sizes and, getting out sooner than we normally would, reduced target levels, all that stuff. So again, it's tradable, just like yesterday was tradable. There were some opportunities yesterday, but there were not a lot. And the ones that were there, they didn't have a very good follow through to them. Right. So, I mean, better than nothing. Take it. But that's going to be what we want to focus on at this point. Once we get past the CPI, we want the other side of this question. Are they going to continue to keep it hedged as tightly as they have it right now, that we stay range bound through most of the week before we get into OPEX? Since we haven't gone anywhere, the evaluation on the 10-week and the 10-day really hasn't changed all that much, except for maybe the 10-day. It'll move up to us faster than the 10-week will. So we're still above it, but we're very close to it. And of course, we're not overbought. We're not oversold. We haven't gone anywhere. We haven't done anything. We're still sitting in the box. So at this point, we need the data to come in, give us a push one way or the other. Remember, the initial push is likely to be a little muted because of how heavily they're hedging. And they're hedging pretty heavy. So the initial movement might be a bit muted, but this data should directly feed into what the market's going to do with either unwinding what they've priced in or pricing in more, right? When they would now want to lean into it a little bit. You can always check for yourself. Just go to Google, type in FedWatch, you get this page. These are the different FOMC events scheduled for this year. Next year's are in gray because they're not set in stone yet. Those dates can change. There's really not a question about this March 20 event, right? Nobody believes we're going to get a rate cut in March. Even for May, that's pretty much off the table. June's where a little bit of questioning starts to come in. They've got it priced in at 60% probability of a rate cut in June. And then there's July. Looking at this, we've got a 40% chance that we would get a cut in July from 5.25 down to 5. But there's nearly another 40% chance that we would already have had a rate cut in June and that we would get a second cut in July, which would take us down to 0.75. Now, I don't want to nerd out this morning and try to go through the math probabilities here, but there is a split quotient between these two that we can try to calculate and ask what's the probability that we're going to get, quote, some kind of cut in July based on 40% from one and 40% from the other. It would make sense that we could just add these together and divide by 2, which would get us around 40, right? This time. That number wouldn't always be so easy to do, but it's a little more complicated than that. Suffice to say that for July right now, there's a really high chance, let's just call it a 50-50 chance, that we actually get some kind of cut in July. Whether it's our first cut or our second cut, there's more than a 50% chance, not much, but a little bit more than 50, that we get a cut in July. Whichever one of these it happens to be. This is what we want to see, that they start to unwind or not after we get the CPI data today. Are they going to pull it forward and we start seeing May and June get bid up with a cut? Or do they start pushing it back and we see June and July numbers fall and maybe September's numbers start to rise? Short and sweet and to the point, this is what everybody's focused on right now because, well, after we get this data, anything that's already up could go down and vice versa. Anything that's already down could go back up. Other than what we call event-based plays, so some of these, maybe some pre-market gappers, these are event-based, so they're not really going to pay much attention to whatever data comes out this morning. It's not like it's going to ignore it completely, but these are already popped because of their own event that's going on, whether it's a new drug trial, earnings, whatever. So a lot of those are still going to be, fine if that's your focus. It's not really something I dig too deep into. But a couple of these names you might recognize, like Oracle. Yeah, that's about the most popular one on the list. Out of our normal list, Jets are down. Really, that's the only thing down enough to meet our benchmark requirements. And in the other direction, Nat Gas is up, KWeb is up, the FANGs are up, or the Mag 7, however you want to approach that. Semiconductors, tech. So those are what we want to see, right? If we're going to have a bullish day, we want to see tech, we want to see semis, but it can't be just from a relief bounce. So we can see SMH, for an example. That was a pretty hardy move from Friday, started to base yesterday. If this is just coming out of its base and running back up to continue this move that it's been doing, then all's well and good. But the other half of that would be that this is just a little bit of a relief bounce, and then we're going to continue the move to the downside. It directly goes to NVIDIA, right? Or any of the other semis out there, MU, TSM, kind of answering the same question. That's a heck of a pullback from Friday. We based yesterday. Nice structure is built. It held above the 50% of just this level, this small time that we have here on the chart. Well, it looked like it had held above, but it's right at the level. So if this is going to be a continuation, then the line is in the sand. It's got to get back above this level and start working its way back up. Now that was just a really close measure based on the end of my chart, not based on a good place to actually make that measurement. Here's last week. And of course, in that vein, we're 100% below the 50. We need to get cleanly above it, begin expanding back up. Same thing on the monthly, below the half. So if this is going to make its continuation run here, then it kind of needs to get in gear and do the thing. So far, it's not looking that bad. It looks like it can keep the move. And everything, if you read Spot Gamma's founder's notes, everything is looking at NVIDIA. So if NVIDIA really does start to unwind, then a lot of this market is going to begin to unwind as well. I don't have it here on the chart, but if you've got an anchored VWAP, you might want to anchor it from earnings. And of course, the way VWAP lags, it should be, like somewhere down here. But if it's not, then make sure we're not about to break underneath. If you're long NVIDIA, that'd be something worth finding out. Don't want to break down through that level. Otherwise, if you're looking for longs, you could start with just getting back above yesterday's high and or through the half back from Friday if you're more cautious and you want to wait. I like the idea of kind of going long early, right? As early as I can. So along the lows when you get that opportunity. If you don't get that opportunity, then you can try 8 to 65. That'd be Friday's low. Then you can add after we get through yesterday's high, add some more once we get through the half back. I don't know if I'd add again around 950 or not, but I'd probably start fading out at that point. Watch the clock, everybody. Watch the flows. And don't forget there's an auction today. It's the 10-year. It's kind of a big deal. It's not the biggest thing we have to worry about, but you don't want to ignore it.